find many insurance concepts hard to understand? Actually, once we use examples to illustrate them, these concepts will become very simple. In this episode, we'll look at insurance premium financing. Insurance products can be roughly divided into two main categories. 1. Pure protection term protection products, which are not used under premium financing. 2. Products that offer protection plus cash value, which can usually be used as security under insurance premium financing. Simply put, insurance premium financing is a financial tool that lets you take out a bank loan to buy an insurance policy and pay the premiums. In the process, transferring the policy to the bank as security. It's a similar concept to mortgages. After approving the loan, the bank will let you repay the principal plus interest by installments. Once it's all paid off, the policy will be transferred back to you. Keep in mind, though, that when you transfer your policy as security to the bank using insurance premium financing, your ownership rights under the policy are also transferred to the bank. In the event of a death benefit payment or early policy surrender while the bank is holding the policy as security, the insurance company will use the benefit or surrender cash value to repay the outstanding loan amount to the bank first. If any amount remains after that, it will then go to the policy's beneficiary or holder. Now, let's look at an example. Mr. Lee, 50 years old, is a senior executive who is looking to branch out. He wants to quit his job and open a small consulting firm while ensuring sufficient protection for his family. So he takes up a whole life insurance policy that has an insured value of $1 million and offers non-guaranteed return. Premium is paid in 3 years, paying around $330,000 per year with a total premium of approximately $1 million. Since the premiums are relatively high and would impact his liquidity, Mr. Lee decides to get an insurance premium financing loan from the bank that's approximately 50% of the policy's total premium and pay the remaining $513,000 out of his own pocket. Mr. Lee chooses a 10-year repayment period. During the first 10 years, he will only need to pay interest on the loan, and in the first month of the 11th policy year, the loan principal plus the remaining interest will be repaid in full. In the meantime, the premium payment to the insurance company will be split between Mr. Lee and the bank. In contrast, if he doesn't use insurance premium financing, he would have to pay a premium of approximately $330,000 a year for 3 years. With insurance premium financing, however, the annual premium payable during the same 3 years goes down to $170,000 plus $44,000 in interest. So now Mr. Lee has more spare capital at his disposal and can open his consulting firm, while the life protection he enjoys will help secure his family's financial future in case the unfortunate strikes. In the first month of the 11th policy year, Mr. Lee, having turned 60, decides to retire. Instead of surrendering the policy, he chooses to repay the principal of the premium financing loan and make the last interest payments with his own savings. He also decides not to withdraw the policy's cash value, leaving it in the policy to earn higher potential return. After another 20 years, Mr. Lee is 80 years old, and the policy's projected cash value is approximately $4.4 million. After the interest on the premium financing loan is deducted, the projected cash value is approximately 421% of total premium paid. At this time, Mr. Lee can choose to withdraw the cash value to support his retirement life or transfer the policy's coverage to his children as a gift. So we can see that in the current low-interest environment, insurance premium financing has enabled Mr. Lee to access high-value insurance protection without using too much of his own savings. He may also enjoy potential return on his policy, thus increasing the appreciation potential of his wealth and boosting his retirement reserve. And with the improved cash flow, he can develop his business with greater peace of mind before his retirement. There are, however, a couple of things to remember. Although insurance premium financing is a wealth management tool, it is also a loan product, so the interest rate is not fixed. It will rise or fall in response to market fluctuations. If the interest rate experiences a sharp increase, there is a chance that the overall return on the policy will be reduced or even cancelled out. And transferring your policy to the bank as security in this way means you agree to transfer your ownership to the bank. so the rights that you would otherwise be entitled to, such as cash value withdrawal, would also be affected. Other risks worth considering include collateral top-up risk, loan repayment default risk, loan recall risk, loss of insurance coverage risk, exchange rate risk, and counterparty risk. The above are important factors to take into consideration when deciding whether insurance premium financing suits you or not. Therefore, it's recommended that you take time to read these main risk factors and consider whether you can bear these risks. To borrow or not to borrow? Borrow only if you can repay.